Good afternoon and welcome. I'm Samuel Sizi. I'm Head of Actuarial Studies and International Affairs at Institut des Actuaires and one of the Young Actuaries Initiative coordinators. And it is my great pleasure to welcome you to the inaugural webinar of the Young Actuaries Initiative French chapter. Today marks the beginning of what we hope will be a vibrant series of knowledge-sharing events designed to connect, inspire, and elevate the next generation of actuarial professionals across France and beyond. The Young Actuaries Initiatives were founded with a clear mission to create a platform for emerging talent in our field to exchange ideas, build networks, and develop professionally in an increasingly complex financial landscape. Today's webinar is especially significant as we have the honor of featuring the winner of the prestigious Score Actuarial Prize in Italy, Beatrice Paravicini. This award recognizes outstanding contributions to actuarial science and risk management, identifying individuals who demonstrate exceptional analytical skills, innovative thinking, and dedication to advancing our profession. She will present her work on parametric insurance coverage against natural catastrophe risk. As we listen to today's presentation, I encourage you to engage actively, ask questions via chat. Beatrice, the floor is yours. Thank you.
Thank you so much for your introduction and for the opportunity to be here to present my master thesis and so my work. Now I'm going to share the presentation that I prepared. So, okay. Okay.
That's perfect.
Perfect. So I'm pleased here to present my master thesis, where I decided to discuss about how now the insurance and insurance industry cannot continue to provide coverage against natural catastrophe as it has done in the past, without opening itself up to the possibility to explore new solutions in order to be better aligned with underwriting policy, risk modeling, and benchmarking capabilities. And so also the idea to explore new risk transfer solutions, such as insurance, such as parametric insurance coverage. And so today I would like to give you quite a big picture respect the work that I conduct. And so my presentation will be divided into 6 main parts. The first part, I will introduce what is a catastrophe risk and as a consequence, the issue of its insurability. Then we can pass to the different possibility that up to now we have in the market, so through alternative retransfer solution, with a specific focus, obviously, on parametric disaster insurance. And then I will close presenting my case study with a specific focus on a branch of parametric disaster insurance, so-called weather-based crop insurance, with related results and conclusion. So let's begin with a simple question that is, what is a catastrophe risk? We have a lot of definition from different institutions. I decided to put here a definition taken from the United Nations for disaster risk reduction, in which essentially a catastrophe risk so is a disaster, an hazardous event, that is characterized essentially by the low frequency, but at the same time, it involves a huge number of humans involved, and not only, and it can cause potentially, when it occurs, very big economic losses. A first big distinction can be easily made is between the natural catastrophe, or also known as acts of God, and on the other hand, we have man-made catastrophe. In this presentation, our focus we will be on this first type of risk. And in particular, in recent years, it has become very important to clarify the source of risk from a primary or secondary perils, because even if the main source of perils or losses at global level was mainly due to primary perils, so for example, a new earthquake that has a very low frequency but with a very high loss potential, and it can also include secondary perils. Then in recent years, we have seen that due to climate change, secondary perils are becoming maybe one of the biggest issues, because they are more frequent with respect to the primary perils, and they can generate low to medium-sized losses. So on one end, we have more issues in terms of severity, but on the other hand, we have issues in terms of frequency. And so putting these two aspects together makes the catastrophe risk quite insurable. And so starting from this point, I decided to put here this table that comes from a common approach, a best practice in the market, taken from Berliner and Carpentier, in which in particular they decided to, in some way, grasp general 9 points by dividing them into 3 major fields. The first is the part regarding actuarial. So the main issues is that largely, so the events are usually hardly diversificable. And in particular, from a statistical point of view, we have that the central limit theorem is not so good applicable to this kind of events, because since the theorem is based on the independence of homogeneous risk, it's quite obvious that an event can generate dependence on one side on geographical point of view, and another side also as a consequence from different also line of business. Taking, for example, the same example of an earthquake, it will impact several number of insured person, so causing damages in buildings, but also potentially on person and other, for example, vehicles. And so this lack of diversification is one big issue to face. And we should face it considering a risk that is, from a probabilistic point of view, something that is uncertain, but using the fact that we should know the probability of occurrence of such an event. And so here, this is also the issues, and this is something that should be taken into account, and something also ongoing, to be considered also in the loss modeling of this kind of event, in which they are quite unpredictable, but hopefully we should so pay attention in the probability of loss occurrences in order to make the maximum possible loss and the average loss per event quite moderate, manageable. At the same time, we can also leverage in order to minimize the moral hazard and the adverse selection, especially from a policyholder point of view, in order to reduce the information asymmetry that an insurance company can have in front of a policyholder, because the insurance company can potentially have an asymmetry. So it is not so aware about the level of risk that a specific person or a specific building could be exposed, potentially could be exposed. Then going to the market economic part, here the real issue is finding a fair price as a compromise between 2 types of interests that are different. One is the interest of the insurer, usually linked to the cost recovery. And so potentially from a statistical point of view, we could have an infinite actuarial premium to cover such extreme large losses. But at the same time, we have the issue of the protection gap. So not so many policyholders are so aware about their exposure to risk, or also at the kind of measure they can adopt in order to decrease their exposure. And also, as a consequence, the financial losses they can have. And finally, we can have the legal part, in which usually it's quite difficult to identify also from a legal point of view, the definition of what is abnormal, an event with a normal intensity of a specific hazard. And so putting all these things together, and the fact that these huge losses from an insurer point of view could be translated into an infinitive actuarial premium, plus the fact that we cannot rely on a geographical diversification, and also from an insurer point of view, a company to be solvent should require additional capital. Then up to now, we have no so adequate short-term insurance market, especially in the period of hard market. So when we have a lack of capital available. And in addition, the increased uncertainty given by climate change, all these points make natural catastrophe hard insurable. And so up to now, we can see 3 major players that can be used in order to face this kind of risk, in order to diversify, in order also to obtain more capital and so underwriting capacity to underwrite this kind of risk on one end, in order to face them. First is that the first option is to transfer a part of the risk to capital market through insurance securities. Then can be considered as a good merge between the financial world and the insurance one. Then we have the traditional international reinsurance product, especially for cat risk. The main product that is used are the so-called excess of loss per event or cat. So they are specific treaty, especially the contract between 2 counterparty. One is the insurer, the direct cedent, and on the other hand, we have the reinsurance, in which in this agreement, the 2 parties agree on a specific threshold in which all the losses in case of a cat program, it will be the sum of all the losses, so the accumulation of losses that have been generated by one single event. So if the sum will exceed the specific threshold, the exceedance part will be paid by the reinsurer. At the same time, the reinsurer, thanks to its geographical diversification and also diversification through different lines of business, can better face the kind of risk. But at the same time, it should protect itself using some policy conditions, such as here I mentioned annual aggregate deductible and annual aggregate limit. These are quite frequent policy conditions that are used, especially to protect the policyholder in the case of deductible, at the bottom of the treaty, while the limit at the top. So the idea is that in annual aggregate deductible, all these amount of losses will be retained by the insurer. Up this deductible will be exceeded, then the program will work. But at the same time, we can have also a limit in the upper part, in which the exceedance of this limit will return to be paid by the insurer. Then at the end, we can have also potentially the intervention or the interaction between the public sector and the private one. We can see different level of intervention and interaction depending on the specificity of each country with respect to another one. And so, given the fact that severity and frequency are increasing on one end due to climate change, and on the other hand, we've also a positive fact that our technology is improving, we can merge together these 2 aspects in order to deploy new solution, maybe looking at the parametric solutions. And so here, I propose a definition from the World Bank, in which an index or parametric insurance is a contract that pays a payout to a beneficiary based on a prefix index for the loss of assets and investment, so as a result of a weather or other catastrophic events. We can see that we need only 3 main steps to build a product like that. So in the first instance, we must collect data, so our underlying data, usually from an official and very specified provider, such as a meteorological agency. And after the collection of data, we should also look at our data in order to clean them in case we have no continuity in the measurement taken. We can have shift or breaks that can lead to a misestimation of our risk. Second, we have to define our index, and there should be a variable that is external, but something that is objective, should be reliable given our data, and also available, because it's good to have a long time series of data available in order to better monitor and define our loss. And then our index should be correlated in some sense to the risk we want to protect from. And finally, we should define the payout function, because if the index should mirror the financial losses that an asset can potentially have from a specific risk that we want to recover from, the payout function should translate the index into a monetary amount. By defining first case, the trigger event, so the specific event that will trigger the payout, and in second phase, also the type of payout we want to pursue. In particular, the payout function is very important to also define the frequency of recovery from an event, from a policyholder point of view, but also from an insurer or reinsurer point of view, because the payout function should pay attention especially on the extreme scenarios, so on the fat tails of a distribution of a risk. Passing to advantages, so we can say that this product can differentiate from the traditional indemnity product thanks to the transparency of payout trigger. Because one crucial point is that here we have no need for loss adjustment, and so as a consequence, we will have lower expenses, because this kind of product does not rely on the assessment of the actual loss incurred by the policyholder, but is quite a faster payout for the fact that we should identify the trigger event in order to activate the payment. And so thanks to these mechanisms, we will have lower also dispute risk thanks to this faster payout. At the same time, even if this product can be seen maybe as the perfect one, it's not so, because we must pay attention also to an intrinsic risk that is specific of this type of solution, that is the so-called basis risk. Basis risk regards the potential mismatch that we can have with respect our payout and the actual loss incurred. For example, we can have also 2 types of basis risk. The first type is when our payout is bigger with respect to the occurred losses, and on the opposite side, we can have that we have no payout or is not enough to cover the occurred losses. And so we must pay attention to calibrate to better calibrate our solution, identify the appropriate underlying data, index, and payout function. So here we go directly to the specific case study. So I decided to focus on a specific branch of the parametric solution, in particular the weather-based crop insurance, that they are in the data product in which the indemnity will depend on the realization of a specific weather parameter over a specified time horizon at a particular weather station. And so during the next slide, we will see the first step, this so-called pre-feasibility assessment, in which I will select the weather risk, the type of crop, the weather station, and the different agroclimatic zone that I would like to analyze. Then the second step will be the technical feasibility, in which we will see the collection of data. In the case, we will have data from rainfall dataset and a crop production dataset, and then the construction of the index. And so in generally, the general design of the product. And then we will have a third part, the field implementation. Here, inside my thesis, only the trigger payout level will be visible, but essentially in this last part is also crucial to identify the right price of a contract and then to distribute to the policyholder. So my aim is to replicate the functioning of a weather-based crop insurance product that will be based on a rainfall index, aiming to protect the Indian farmers' crop production against severe natural events. So I was aware of the fact that it's very difficult to build a perfect product given the data available that I had at the time. So my main purpose was to see how a product of this time could be built. So also the issue that we can face. And at the same time, for me, it was also important to see this case study from two different perspectives. One perspective was mainly linked to the insurance company point of view, in order to face this kind of risk exacerbated by climate change, because we know that at top of all the line of business, agriculture is one of the fields that should reinvest itself, finding new way to protect the production against severe weather conditions. And on the other hand, from a policyholder point of view, in this case, Indian farmer, that is his will is to protect himself against severe natural events in order also to face future potential financial loss. And so we start from the feasibility assessment. So I decided to protect the insured against severe droughts and excess rainfall, and also the combination of the two events. Because taking into consideration India as a country, I choose India because according to FAO studies, for the year 2021, India was ranked at second place in terms of crop production. And at the same time, the rainfall variation accounts for over 50% of the crop production variability. And so this there is quite a very direct correlation in the way how weather can heavily affect the crop production. That is a key line of business for the Indian economy. In this case, I was very specific to select the winter wheat crop production. So I decided to divide the different growth phases, also very detailed given the different days and definition. In particular, in the next slide, we will see that our index, we pose attention on these different growth phases, and in particular on the flowering one, because it's the phase that it is the most sensitive phase against rainfall variability. Then I decided to select 4 India states located in a different agroclimatic zone, because for my analysis was also interesting to see how the data, the parameter, return different results depending on the specificity of each state. And so now we are at the technical feasibility. And so first I collected all the data related to the crop production from the Indian government website. I take quite a long period that I decided to divide into 2 sub-periods. The first is the period during which I conducted some analysis in terms of average production, also average yield, also in order to select the specific states. And it was interesting to see how the production compared also to the sites of each state could influence the yield of the production. And as a consequence, the yield of production was affected by the rainfall variability. So here I put some numbers linked to the average yield during this first period, so from 1997 to 2010, and the related variability. The average production was measured in tons, but we know that a contract and the payout relies on monetary amount. And so I assumed to give a price to the average production and to translate it in the so-called average production value in euro. In particular, focusing my attention on this second period, so on these 9 years, from 2011 to 2019, because here is the period of our case study, of our analysis, in which we will calculate the payout. Then, so why the same reasoning can be applied to rainfall data, measured in millimeter. The main source was the meteorological department, so an official provider. Also here, divided the data set into some period. The second period is the same for the crop production in order to be aligned for the calculation of the payout. But it's quite interesting the analysis that I did on the first period. I took quite a long period of 50 years in which I calculated the so-called long period average, that it will be our quite focus, our main parameter for this analysis. And also here, I then compare data, calculated sigma, coefficient of variation, and also quite the distribution that the rainfall for the India state taken as a country, as a whole, and differentiating by the different 4 Indian states. Maybe now going to the construction of index, all this first part maybe will be clarified in a better way, because given these 2 data sets, in particular now focusing our attention on the rainfall data set, we can see that we can have simply only 3 main steps. First is the calculation of this average, long period average, for India as a country, but in this case for each of the 4 selected states, on annual basis and also on seasonal basis, to give relevance to the crop growth. Then I assume a normal distribution of the rainfall time series. And so it was also very important because when in the first step, I calculated this ratio, so taking the observed rainfall value over this average, then the result is a percentage. And this result then is classified into these different rainfall categories, from one excess, so a large excess of rainfall, to another opposite, a total deficit, so no rainfall. And jumping already into the field implementation, there was also this strict link with the identification of these different rainfall category. We respect then the payout structure that I would like to propose inside our solution. I decided to present two cases, one called A, or soft, the second is case B, or hard. It says that this payout structure is the same, except for the central cases, the central scenario, for the excess and the deficit. In the soft case, the insured person will have a higher payout because here I use 25%, we respect 10% for the hard case, for example. I wanted to make this distinction in order to see how many times this product can be activated, but not only, also in terms of amount. Because in this kind of insurance that protects the crop production, maybe it's also more difficult to identify the amount of money to be paid to the insured person, because we respect a normal property contract in which we want to protect a building. So we know quite for sure the sum insured of that specific building from the crop production is quite difficult. And so also having this in mind, I use the crop production also as a sum insured for this kind of product. And so also see the different payout structure and how this structure can affect the repayment is for me quite important for the well functioning of a solution of this kind. And so here we have we have 3 indices. So I propose 3 indexes linked to the cumulative rainfall. The process is quite the same. The only difference is the type of observed rainfall value and the average that I use. In the first index, we use data calculated on annual basis. In the second index, we use seasonal data, so splitting the data for each of the 4 seasons, while the third index is quite equal to the second one, but with the addition of a specific weight. So now every season can in some sense measure its contribution to the specific development on the crop production. And as I said before, since the flowering phase is the most sensitive phase against natural catastrophe, I decided to put the highest weight for this season. But and then finally we will see in the next slide that I conducted this analysis for these 3 kind of index, and for each index I presented kind of 3 possible trigger events. One event is the combination. So in general, we cover both the excess and the deficit of rainfall, while the other 2 trigger events are covering only the excess scenario or the deficit one. Maybe it will be more clear in the next slide, because here I put an example. So taking, for example, the state of BR, and taking the first index, so the total annual rainfall index, in which all the value, the observed rainfall value and the average are calculated on annual basis. And taking, for example, the year 2018, I took the value of 861, comparing over our annual long period average over these 50 years. And then the ratio returns a minus 26%. According our rainfall category, it is recognized as a deficit situation, so a deficit scenario, that will pay out 25% in the case soft and a 10% in case hard. So here, just to give you the number, so how for example, if we take 187 payout amount that is expressed in million, is obtained multiplying the payout structure for the soft case times the average production that I calculated over my first period of the data set that I used as a benchmark, as my benchmark for the sum insured that I would like to repay to my policyholder. But at the same time, the idea was to report this average amount to the specific year of the analysis, in this case, 2018. And then the last thing that I would speak about in this table is that just to have a rough idea about how many times this policy has been activated, and also in terms of payout amount, was interesting to see per 1 unit of production expressed in a monetary amount would have been. So in this case, if we consider the total amount of the payout, summing all together these 9 years of the analysis, assuming to have a policies made on annual basis, but with a continuous renewal over these 9 years, it's visible that the overall sum considers the first trigger event, so covering both excess and deficit. We have that this policy has been activated only twice, with a total payout amount of 380 million. And it corresponds to 0.46 percentage in the, if we consider this payout amount over the potential of the potential crop production over these 9 years. So here we have the same state, but in this case with a different index that takes into account the seasonality. And here, for example, if we consider the winter season, taking the same year, 2018, we have, for example, a very extreme situation in which we have no rain. So we have a potentially the 100% of the payout amount. And now we can see also how many times this product has been activated with a very huge amount of payouts, and also in terms of production. But maybe, so in one case, here it is quite evident the presence of basis risk if we consider the annual index, or in this case, a seasonal index, that maybe it fits better because it takes into account like the distribution of the rainfall, but not only, also the contribution that the season gives to the crop growth. And then passing to the weighted annual seasonal rainfall. So the only difference with respect to the previous index is that now, taking, for example, the same year, 2018, this extreme scenario of no rain has become a quite normal situation of deficit. And so it will be translated into a reduction of total amount, not only of the specific year, but also as the sum of all the 9 years. So these 3 slides were just to give you also an example on how all the numbers are built. But maybe it makes more sense to see this part, so the overall results, in order to compare how results can differ from a situation to another, and so how much is important to calibrate parameter to be so much as specific as possible, to identify the risk we want cover, the localization in the case of a crop production we want to analyze, because it's quite easy to have situation in which we have a payout, but we have no an actual loss, or at the same time, the payment is not enough. And so looking at the first table on the left side, here I use the long period average calculated at country level, so India, and I decided to apply the same average also for the two states of Bihar and Madhya Pradesh. And obviously, it's wrong. It's something that should not be done, because of course, it returns biased results. And it is visible if we consider the same two columns of Bihar and Madhya Pradesh, take into account the column of total annual rainfall index. We see that maybe from Bihar, the results are quite the same. The results are totally different. In the first case, in which we wrongly use the long period average as a parameter to be compared to the observed value, while if we use the specific long period average, so calibrated on the specific time series of the specific state, we see that the situation is completely different. And for example, we do not see so extreme scenario in the end. Now we can have a totally different situation if we consider the second index, so given relevance to the seasonal part, in which, for example, also here, if we consider the seasonal and then the weighted seasonal index, we can see that all the extreme scenarios, so all the years with extreme category of rainfalls, then can be transformed into quite, as we can say, normal or converging towards the central part of the distribution. And so it's also quite visible in terms of total amount paid and how many times the policies has been activated. One last example, also maybe extreme example, is the case in which we have no payout if we consider a season, the monsoon season, which contribute to the crop growth is quite minimal. And so also we reflect this contribution into the weight of only 5%. And so taking this picture as a whole, to understand how much is also important the usage of technology and the improvement of the basis risk in order to build products that are potentially useful to face uncertainty. And so in conclusion, parametric solution can be seen to be an innovative alternative, and I would like to add also complementary to traditional insurance, especially in condition of hard market, so when we have a lack of capital availability, because this product can potentially give coverage on uninsurable risk worldwide, thanks to the fast and transparent payout that is based on objective and external variables. But take in mind that it's important to minimize basis risk. In future, we should also overcome limitation in data access and in the collection of the underlying data. But in recent years, we had also a very good improvement, also thanks to the generative AI, in order maybe to face these issues and to limit some problem that could lead a misestimation of the risk. And also the applicability of this kind of solution can be very very, very wide, from microinsurance to public authorities, not only maybe facing on natural catastrophe risk, they could also be a good tool to reduce the gap reduction, so to provide faster coverage also in areas that are very exposed to climate risk, to natural disaster, and at the same time, people are not so aware about that. And at the same time, also, these policies can be built as a standalone strategy, or as I said at the beginning, maybe also together with traditional insurance. And so, thank you so much. I hope to have give you a quite big picture, also to be clear, and so thank you for your participation. Now, I see if there are questions available. Okay. Okay, thank you for your question. So the first that I am able to read, did you have an opportunity to compare your payouts with actual loss data? Is a very good point, because unfortunately I didn't have the opportunity to have this comparison during my analysis, because usually this also kind of information are quite private, and so I didn't have access to actual data. But for me, it would be interesting to see, yeah, the relation. The point is that the timing of rainfall is crucial for crop yield. Rain during or just before harvest can be detrimental, while it is very positive just a few weeks before harvest. How can you take account of this in your parametric insurance designing? A seasonal index is not precise enough for this. Yes, Matthias, that's the point. So it's also the point that I said before, that I try during my analysis to see the potential issues that someone could face, and also the potential solution. And it is very good point, because I discussed also with my correlator during the analysis, and I didn't, as I said before, I didn't have access this kind of so specific data. And so for me, from my point of view, it was a pity, because yeah, this season is maybe the seasonality, yeah, does not take into account this so specific aspect that is also quite very specific item related to agriculture as a line of business. And so obviously a potential index should also take into consideration not only the seasonality, the contribution to the crop growth, but also the composition of the specific soil, and also the period of rainfall before and after the harvest. So thank you for your point. Okay, then I have another question regarding the rationale behind the rainfall category. It's a good point, because the rainfall category that I showed before, that are taken from the official meteorological agency of the Indian state. So it was something that was, from my point of view, well calibrated. And so given also maybe my lack of availability of some kind of data, I decided to to take as a good benchmark this kind of classification. Maybe also with also the rationality behind that the time series is assumed to follow a normal distribution. So with the idea that usually we have that usually the observation will fall inside our 68% of range between the mean and the standard deviation. Another question was, have you measured the basis risk for a real case? How is it possible to cover? Yeah, I didn't have the opportunity to measure basis risk because, as I said, up to now, many of this kind of information are private, and so it is not so it's not so easy to have access of this type of data. But yeah, it is a good point to point out. Then maybe we have two last questions. One is it making sense to build a cat bond product type to cover property, building, or agriculture in island located in different geographical area? Yeah, as I said, cat bond product are under the insurance securities, so mainly to the financial sector, capital markets. And I think that also the sense of the cat bond, maybe it could be useful to in some sense, offer a product respect to risk in an area, as you said, so in area located in different geographical area, because yes, the idea is that this cover can give a capital relief from maybe an insurer point of view, but at the same time, the investor should be aware of the fact that what is covered, it could be potentially could lost its nominal part in case the occurrence of natural event that is the object of a cat bond. And so maybe it is good to build a cat bond product, but it depends on the type of hazard you want to build on this product. Because, for example, usually we can have a cat bond product covering earthquake. And because, as we have said, they are also primary perils that have a low frequency. So maybe it is a question that is not so much related to my analysis, but maybe is a very point because maybe it's also good to think about strategies in which we can merge this cat bond product, and so more the world of the capital markets towards also the idea of insurance of a parametric or alternative solution product. And then another person said that how important is data collection in the setting of payout triggers? Do you see any applications for Internet of Things in the monitoring of parameters? For example, installing rain sensor in the crop that are insured. And is the thesis published? Yeah, the thesis is of course available on the SCORE website through the section of SCORE Actuarial Awards. So in case you want to have a more, if you would like to have a deep dive into my analysis, it is available on the SCORE website. And for the question, it's very important because during these recent years, actually a lot of companies have built also their underwriting policies on parametric products using the Internet of Things. So the idea that now parameters, sensor can help to face the basis risk, because we can have, for example, an on-time measurement, and so it for sure helps to be more precise in order to fix the trigger. So thank you for your question. Who are the actors offering parametric products? Well, good question, because, for example, Score is one of the players that actually is offering parametric products. So usually, in general, all the reinsurance players are potentially selling this kind of product. But also we can see also some very specific player that are quite recent, to be honest. And as I said before, using the generative AI, the new world of sensor and the Internet of Things are offering this kind of product. Also related, sometimes maybe we can also have a collaboration between this specific provider of this kind of product and also some funds or more financial provider. Yeah, or AXA, for example. Yeah, and also I was speaking about reinsured, but also direct company insurance like AXA. So company that have a also international footprint is quite important. They offering in parametric product. So thank you. And yeah, at the moment there are no more questions. So okay. Thank you so much for your question, because they were very interesting, and also some critical point that I face. I am also maybe happy that I share also this point of view about issues with you. So, and as I said, if someone would like to have a deeper look about my work or want to contact me, feel free to do it. So I would be happy to answer to your questions, suggestions, and also outputs. So thank you, and have a nice day.